Right, grade 12s. In this lesson, I want to look at the buyback of shares. Now, remember that a company sells shares to prospective shareholders, and they then become the owners of those shares, and they become the owner of the company. Now, in the normal course of the events, those shareholders, if they want to sell their shares, will have to sell them via the stock exchange to another shareholder. But under the New Companies Act, it is possible at certain times for a company to buy back certain of their shares. Now, they would do this, for example, if they've got a whole lot of spare share capital lying around that they're not using, and rather than paying out dividends to shareholders that has not been fully utilized, they might well decide to buy back certain shares. Otherwise, it often happens that through an estate or somebody's dissatisfied with the company, rather than sell the shares, the company decides to buy back those shares. However, we need to take note that there are two restrictions in this. A company has got to be liquid and it's got to be solvent before they can buy back any shares. Liquid meaning they've got enough cash resources, their current assets are more than their current liabilities, and solvent means their total assets are more than their total liabilities. So they're not allowed to go and borrow money to buy back these shares. Now, having adhered to that, if they decide to buy back these shares, what does it actually mean? Now, if we go back a step, remember that shareholders, when they initially buy these shares, that money goes into an account called the share capital account. Now, as long as the company's got authorized shares, they can keep issuing these shares. And these shares get sold, the individuals buy these shares, and the amount in the share capital increases. Now, once the company is actually trading, though, that takes us on to the next step. And that is that the business is going to start making a profit. Now, that profit has to be appropriated, divided. And the first thing, under the regulations, income tax has to be paid. Providing there's money left over after that, that money then belongs to the shareholders. Now, the directors will get together, they will decide, they will make a presentation at the AGM, and providing it's approved, a decision will be made to pay some of that as dividends, and dividends is nothing more than a sharing of the profits to the owners, the shareholders, and they might keep some in retained income. Now, if they're keeping in retained income, it's because they want to grow the company. They need more capital for the future, and rather than go and borrow it, which incurs interest, they can retain this. It's the cheapest form of capital. Now, they might pay all of the money after income tax out in dividends. They might retain it, or there might be combinations of it. The important thing is that some of it will go out as dividends, but the rest will be retained. And so now when we look at the shareholders' equity, the shareholders' investment in the company, it's not only their share capital, the capital they put in when they bought the shares, but it's their share of the profit that the company's retained. For example, if the company kept back profit last year, you as a shareholder are entitled to your share of that. The fact that you didn't get paid out doesn't excuse the fact that it's still yours. And so when we look at the shareholders' equity, it's made up both of these. Now, when we come to buy back the shares, we want to pay back the shareholder for his shares. But we're obviously going to have to pay him back for the price that he paid, but we've also got to pay back his share of the profit. Now, that's not always so easy to determine. First of all, the amount that these shares were bought for over the time has probably differed by a large amount. And so you've got to determine this particular shareholder, what price did he pay? And that becomes too difficult to track, especially if you've got thousands of shareholders that are trading on a day-to-day basis and the ownership is changing. Also, you've got to go back and work out how many years he's had and what profits he was entitled to. So we now bring in a new thing where we work out the weighted average. Now let's look at this example. At the beginning of the year, you had 400,000 shares issued, and that brought in an amount of 4,800,000. You then sold another 80,000 shares, and they brought in another 1,320,000. So that's the amount of your share capital, which amounts to an amount, if we add up this, of 6,120,000. Now that 6 million, that was that money there, was used to buy 400,000 shares and another 80,000 shares. So that represents a total of 480,000 shares. Just look at that. You've sold 400 and another 80. You've sold 480,000 shares, and those brought in that amount. They brought in that. Now these shares here, these 480, could all have been sold at different amounts. And as I said, we can't go back and try and work it out. It's just too time consuming. So we work out a weighted average. And a weighted average, we take the amount of money divided by the number of shares. And because shares always work in cents, we will times it by 100, and that will give us an answer in cents. Right, so that works out an answer of 1,275 cents, or 12 Rand 75. So if we go to refund, when we buy back, and in this exercise we're going to buy back 30,000 shares, we're going to have to buy back, repurchase. We're going to have to pay back to the shareholder, first of all, 12 Rand 75 for the 30,000 shares. But now remember, I said to you, we've also got to give him some of his share of the profit. Now it'll be beyond your school syllabus, but you'll be told that the company will decide that onto this they must add on some retained income. And so they decide, and as I say, you'll be told this, they are going to buy the shares for 14 Rand. They're going to buy back the shares at amount of 14 Rand. That's in order to refund the shareholders for their money they paid when they bought the shares. And then also, we want to give them a share of the profit. So we're going to add on an extra 1 Rand 20. That is coming out of the share capital, and that is coming out of the retained income. So we're refunding them their purchase price of the shares, and we're refunding them a share of their profit. So if I was to fill that in over here now, I would say, right, this 30,000 over here, I would pay back this at the average price of 12 Rand 75. Now, just stop and think, learners. This calculation here, in which we calculated this 12 Rand 75, was done on the share capital account. You use the figures there, divided by that, and you got 12 Rand 75. So that 12 Rand 75 belongs in the same note. That is the average price of these shares. So you are going to buy back 30,000 shares at 12 Rand 75. The other 1 Rand 25 is going to come out of the profits. So what we're saying is an amount of 382,500 comes out of the capital. You don't have it any longer. And 1 Rand 25, or an amount of 37 Rand 500, comes out of the profits. You're reducing your profits. So take note, both of these must be in brackets because you're reducing the accounts. From the shareholder's point of view, he's going to get a refund on his capital. He's going to get a refund on the share of the profit that he never got at the time. So he's going to get an amount of 420,000. That is exactly the same as if I'd said 30,000 times 14 Rand. But in these two notes, that has to be split up because you're paying them out for two different things. One is to refund them on their shares, one is to refund them on their share of the profit. But later on, you're going to move into cash flows, and a cash flow is your bank. And we need to take it again. This is the amount that is going to come out of your bank. So you're paying out 420, 382,500 comes out of share capital, and the balance out of retained income. Now this is almost a certain question in any test, any examination. So you are strongly advised to spend some time and make sure that you know how to calculate the weighted average, and then how it's the weighted average that goes into the share capital, and the difference between the purchase price and that, which is the refund on the profit. Right, good luck learners, and just try that until you're absolutely certain you know what's going on.